Yesterday, I caught up with Tai Hui, the Managing Director and Chief Market Strategist Asia of JP Morgan Funds. I began by asking him exactly this. What is going to be the impact of these snap polls and deferral of taxes and this big yen printing by the BOJ? What will be the impact on Japan and other Asian economies? Just listen into that conversation. Most interesting.
If you're purely looking from a Japanese perspective, I think you're starting to see investors, whether it's institutional or retail investors, to feel more comfortable in investing in overseas markets, including emerging markets. But one thing to bear in mind is because of the aging population and the number of retirees or people who are about to retire and their financial requirements, they still have a much bigger propensity to invest in fixed income products. So in that sense, what I expect to see is, at least for the first wave of these Japanese money coming out, I think they will be looking at either developed markets or emerging market fixed income. They may want to take a slightly more conservative approach when it comes to equities.
Okay. The last time around, when we had the first wave of Abenomics 2 years ago, we saw a lot of funds getting attracted towards Japan. Will there be a second wave? I mean, that starved the emerging markets a bit.
Well, I think it's not necessarily at the cost of emerging markets, but certainly I think with the BOJ's latest round of measures and subsequent depreciation of the yen, we probably will see another wave of market interest in Japan. Especially with the fact that the economy continues to be pretty weak. Even though with the postponement of the tax increase, I think the expectation is the Bank of Japan will continue to flush or provide a lot of liquidity to the system. So I think, we will see investors looking at certain investment themes in Japan, but that's not necessarily at the cost of emerging markets.
Okay, what about the currency itself? We saw this dramatic drop in the yen. What does it do by the end of 2014 itself? I mean, is it 120 as some people are saying?
Well, I think we are running out of runway for 2014, so I suspect we probably will be consolidating around 115 to 117. But for 2015, I suspect there will be a bit more weakness coming through. Partly it's a broad dollar strength story that we believe in, but at the same time, expectation of potentially further easing by the BOJ could push the yen for another round. But one thing to bear in mind, if you look at the movement of the Japanese yen in the past several years, it typically moved very violently in a short space of time and then consolidate for an extended period of time, say 6 to 9 months, and move again. So, if you've missed the boat, it might be worth just being a bit more patient for the next round of weakness.
And that could be in the first half of 2015, you think, the next bout of yen weakness?
I think it will depend partly on, obviously, the BOJ, but at the same time, the aggressiveness of the Federal Reserve in this normalization of monetary policy. If they start to raise interest rates sometime in the middle of 2015, I suspect the yen weakness might come around that time.
Just shifting focus to another central bank, which is also in a mood to print a lot of currency, ECB. Are you expecting a bout of quantitative easing from them? And what does it do to the euro?
Well, the head of ECB, Mario Draghi, made it very clear that they are very much looking forward to engage in another round of quantitative easing. The magnitude he mentions will bring us back to the previous peak in 2012, which implies about €1 trillion of money printing, or 1.25, 1.24 trillion dollars. So if you combine the BOJ and the ECB, next 12 to 18 months, they're probably looking at $2 trillion worth of money printing. Is it going to work? That's questionable, because ultimately it's not so much about low interest rates. Interest rates in Europe is already very low in nominal terms, even though in real terms it may be still relatively high, but that's not the issue. The issue is really banks are reluctant to lend because of uncertain regulatory environment. So the central bank can print as much money as they want, but the transmission mechanism right now is facing quite a bit of blockage.
What would be your preferred equity markets?
Well, if you look at developed markets, I suspect US is a very clear favorite, but it's also very consensus, partly because they've delivered very consistent earnings growth to investors, and therefore is a very obvious choice. Japan, as I mentioned earlier, is a function of the yen and also policy from the Bank of Japan. Europe is obviously the less preferred child right now. But I do think there are interesting opportunities because we're starting to see companies in Europe benefiting from a weaker euro, benefiting from low interest rates, and fiscal austerity in Europe is also going to lighten up. So some of the drag on the economy that we experienced in the last 2 or 3 years should also start to become less influential. So overall, US is an obvious market that we like, but Europe, it could well be for investors who park their money in Europe in the past 12 to 18 months. Unfortunately, the performance has been somewhat lackluster. I don't think we should give up hope on Europe just yet.
All right. But what about Asia, the world where you will be investing? What will be your pecking order?
Well, interestingly, I think India is in a very strong position. Not only the political environment has changed for the better, but at the same time, if you look at not just Asia, but emerging markets, the larger economies, India, China, Brazil, Russia, India seems to have or enjoy quite a lot of upside potential in its growth momentum. If you look at Brazil, Russia, commodity prices clearly is a weight on their economy. China, I suspect growth will be at 7.5%. Not terrible, but not fantastic either. India, I think, with the economic cycle already starting to bottom out before the election results, I think we are starting to see more favorable macro environment. And also, a low commodity price or falling commodity price is absolutely working in favor of the Indian economy.
Okay. So would you worry about valuations already in India?
Well, our research suggests that valuation is only just slightly above the 10-year average if you look at price to earnings, and actually below a 10-year average when you look at price to book. So I'm not that concerned with valuation. At the same time, you have to remember that if you look back to many markets in the past 5 years, high valuation doesn't necessarily mean bad performance. Look at the US. I've been asked the question of high valuation for the whole year, yet it's still turn out 10% return. ASEAN is a market that, again, has been trading above average valuation for the past few years. Last 3 out of 4 years, it's performed reasonably well. So obviously, we are watching valuation very closely. When it gets to a certain level, we start to get a bit careful. But I think we're still some way away from that, and the macro fundamentals is still favorable.
Okay. Despite all this pro-India sentiment, pro-Indian economy sentiment, actually since the coming of the new government, it is the defensives that have done well, the US exposed sectors, the IT sector and pharma. What would your own preferences be? Do you think JP Morgan would start concentrating more on cyclicals? Well,
I do think cyclical has a much better potential from an Indian perspective, partly because of the economic cycle. So with or without the political changes, the change in the economic cycle, in my view, it does favor cyclicals, whether it's infrastructure, whether it's the financial sector, and also, of course, there's a structural development story behind all this. It's not just about the cycle. If you look at urbanization, the rise of consumerism, the demand for banking services, all of these are feeding into, again, the cyclical sectors. So I think, where we look at, in the past, defensives or some of the export markets, that enjoyed its bouts of glory last year, but I do think that looking ahead, the potential is better for some of the cyclical sectors.
Okay. You spoke about problems of recessionary conditions in Japan as well as in Europe. What's the sense you're getting about commodities? Will this low commodity price trend advantage India, disadvantage Brazil, Russia continue for a better part of 2015?
I suspect so. Because if you look at the demand fundamentals for a lot of the commodities, whether it's industrial metals or energy, global growth next year, I suspect, will be respectable but not spectacular. So what that means is that demand growth of metals and energy will be positive but moderate. And meanwhile, if you look at the supply side, the shale gas, shale oil revolution in the US is very much ongoing. And meanwhile, on the inventory level, China is holding a huge amount of metals, whether it's by the private sector or by the state sector. So all these put together, from a fundamental perspective, it's hard to be very bullish on commodities. The only aspect which may have an argument for commodities is the fact that it's underperformed in the last 4 years. So, if you're a technical, if you like technical analysis, it does suggest there may be a bit of a bounce, and also some of the speculative position have been cleared out. So that is a mild positive. But from a fundamental standpoint, from a strong dollar perspective, it's hard to be very bullish on commodities.
Okay. Well, finally, this growth scare that came in mid-October came out of nowhere, really. And you're talking about a weaker yen and a weaker euro also, perhaps. So, US can suddenly worry about the dollar's strength yet again. And the growth scare, after all, when central bankers are printing money, there is a growth scare as well. Do you see that punctuating this positive equity scenario that you're painting? Can things get suddenly out of hand?
I think definitely in 2015, the underlying tone for equities is positive. But you will get bouts of exactly what, as you already said, whether it's growth scare or if you go back to the summer, concerns on geopolitics, Russia, Ukraine, ISIS. All of these are going to be factors that will create or generate volatility in the market. And that's the nature of equities, is more volatile. So from my perspective, if I look at a long-term, 12 to 18 months at least, investment horizon, equities still get my vote, but I am also sympathetic to the point that you will get bouts of volatility. To some investors, that might be an entry opportunity, but for me, I would typically suggest investors to sit through this unless there's a fundamental change in the economic structure or the economic fundamentals of the global markets.
Okay.